wanted to say thank you first for everyone that's going to join in today. I have my very special guest, Mr. Aaron Chapman. And before I continue, can I get an okay to see if we can hear us, myself and Aaron? Can you say something to see if they can hear your voice?
I can hear you fine, and here's mine.
Let me see if I can go to OD on Finance, because that's where we see all of the... Just going to do a quick check. Can you guys type in if you can hear it? I think I can see me on the live. I just wanted to make sure you guys can hear us as well. So just, okay, perfect. I think Aaron can hear us. So What we're gonna do is just go over some really basic real estate investing topics that I shot over to Aaron. But before I do that, let me just introduce Aaron Chapman. Aaron is actually my go-to mortgage lender for all of my rental properties. So a little bit myself first. I have about 7 properties. I just acquired one more, which is a duplex, so a total of 8 properties and 9 doors. And for the last couple of just 2 years, I've been focusing on BRRRR investing. And BRRRR investing essentially is to buy a property, and I'll go into this a little bit further in detail, rehabbing it and then renting it out and then refinancing it. So how Aaron came in is when I wanted to refinance my property, I didn't want to wait, a year seasoning. So I found Aaron through another investor friend on Bigger Pockets. And after, I think, looking over 20 lenders who said, no, you're crazy. There has to be a year seasoning. We can't help you. You don't make enough money. You're an optometrist. What, you make X amount of money a year? Go somewhere else. So anyways, I found Aaron about a year and a half ago, and I messaged him. And I think I messaged you, Aaron, like 5 times or something. And you were so kind, honestly, to answer all of my questions that I ghosted you. I literally okay, cool. I got everything I needed. And I didn't even contact Aaron for the next year and a half. And
I did not know that. Thank you for the confession.
Yeah, this is Aaron. He's so nice, but thank you for all the information. I'm just going to do my thing. And a year and a half later, when I've really gotten to BRRRR investing, I reconnected with Aaron. Of course, Aaron was so generous to give me all his time and knowledge, and then he became my go-to BRRRR lender. So that's how Aaron got into my life and has really made investing so much easier for me. So I just wanted to introduce Aaron Chapman. He is the leading, I think, you're ranked 14 out of 300,000 lenders in the United States. He's been in the business since I try to remember, what was it,
1997.
97, when I was 11 years old. Sorry. And
I used to be, I was the youngest guy in the industry at one point, and then one day I woke up and everybody's younger than me. I don't know how that happened.
Yeah, you inspired everyone, to get into what you're doing. And currently he works with, homeowners, investors, and you are literally by far the most active. I don't think I've received as much YouTube video podcast in regards to, mortgage times of COVID compared to anybody else but you. Aaron literally sends me a YouTube video maybe every 3 days, updating me on how the mortgage industry is in the last couple of months. So he's been very, very active helping real estate investors understand the climate change in the last couple of months, and also what to do about that climate change as well too. So before we begin some questions, anything else you want to say about yourself, Aaron?
Well, thank you for the intro. I appreciate you putting me on here and allowing me to speak to your audience, the people that are trying to understand the real estate investing thing. And it has been an interesting road to run down and really get to a point where I work with the real estate investor almost exclusively, an industry that tends to lean towards working with realtors and working with first-time home buyers, have left the real estate investor off to the sideline to kind of fend for themselves, as you have experienced.
Right.
And so I decided in 2003, when I started working with a few investors, that I really liked the conversation. So I started adjusting my business to really cater to that group. And I'd found in the past that I was always struggling to keep business flowing, and I was trying every type of loan program that existed. So I discovered that when you try to be everything to everyone, you become nothing to no one.
Mm-hmm.
So except for, I started to really figure out who I wanted to work with. So I really dug deep into working with a real estate investor. It wasn't easy. I mean, it
Yeah.
was real tough to build that following. Now, as you pointed out, there's 300,000 people in the United States that do what I do, and I'm ranked in the top 10% of 1%, if you will. And
Mm-hmm.
reality, I'm in the 1% of 1% when you start looking at the numbers. But I've been blessed to really build an awesome business. I got a team of 22 people, and it's been awesome. It's been a heck
Yeah.
of a run. I've got at least 20 more years left in me. I'm only 45, so when I go to the grave, I'm coming in hot.
Yeah, and you know what? When I contacted you just a year and a half ago, I don't think I saw that many names on your carbon copy email. I think it was you and maybe two other people. Now, when I email you, I get like a whole group of team members. I think you've added on in the last couple of a year, right? Less than probably a year, you added more team members just because your business has been growing so much. And, us as investors, we really appreciate it. When I email Aaron, if I don't get Aaron back, someone will get back to me right away. And the great thing about Aaron, he responds to all of my text messages. So, I really appreciate you just being so helpful, and especially for myself being such a new real estate investor. So I wanted to go over some questions that a lot of our optometrist colleagues have asked. So since Aaron is in the mortgage industry, asking all these questions I've compiled are pretty, important during these times, especially for those who are wondering if it's a good time to buy real estate now or wait. I don't know if you know, Aaron, but in the last couple of months, 2 months or so, a lot of our optometrist colleagues have become unemployed. Our offices have closed. We have relied on government funding. We are on unemployment income, and income is now just been from, we're being very profitable to nothing at all. So a lot of our optometrist colleagues are just really concerned about getting financing, considering that they may have incurred debt and negative, remarks considering being on unemployment income. Can you go over how that may affect them getting financing in the next maybe 3 months or 6 months once they consider buying a property, or even as an investment property or as an owner-occupied property?
So the rules are still kind of being adjusted when it comes to this. Traditionally, how it is if you've had some sort of interruption in your income or cash flow, it's changed from what it was to something different. We got to get some stabilization done.
Okay.
So going back to work and getting things running again, that's going to help, of course, right? And then I think that usually you're going to look at a gap in employment with some sort of with some sort of understanding of what caused it. Well, we all know what caused it. So I don't think that's going to have the kind of effect it had before, when a person's business may have failed or something went sideways with their job, and then they went 6 months or a year without a job, then went back to work. Well, you have to have a history now built back up. When you're talking about a person's business that's been going for years, and now you're forced into this particular situation, and there's many people that have put aside enough capital to exist personally for 3, 4, 5 months and continue to pay their bills, then go back to work, and everything's back on track. Well, I don't see it being a major effect. I just don't have any of the data that can tell us exactly how we document it yet.
Right.
I know that they're working on a lot of those things. One of the things I put out in the most recent videos, and I think that you may have watched today's, where we talked about forbearance being something that people are having to consider. They're reconsidering how those rules work, because in the forbearance world, if you take forbearance, the only way to become eligible for a loan again after that is to bring it current and then show current for 12 full months. Well, which makes sense. If a person had some financial issues that put them in a position like that, you want them to get their feet underneath them. 12 months is not a long time for a person to get to stabilize. So that makes sense. In this environment, they're going to continue to reevaluate and figure out the best way they can with that.
Okay, got it. So let me go ahead and there you go. So knowing that, now let's say in a month from now, all the doctors are back in their clinic, they are off unemployment, they are getting their normal income again, they can show that their profit and loss have rebound almost to maybe 80 to 100%. What kind of financing do they need to get started in real estate? In terms of, is there a certain amount of emergency fund they need to have, or sort of liquidity they need to have in their bank to qualify for financing?
Well, one, you need to have the capital to be able to do an investment. So we have to be able to have a transaction, which is typically about 20%. Then we have to have a certain amount of reserve.
Okay.
So, now, are you getting any of the feedback? Kind of like a repeat?
Yeah. I'm hearing a little bit of a feedback.
Which I find is interesting because it seems to be repeating twice. I'm wondering if we need to switch to some sort of like
your mouth move, but no sound is coming out, and then vice versa.
Well, I'm hearing mine go twice. I'm saying it. Are you getting that?
Yeah, I can't hear you.
Are you getting that?
Yeah, like you're moving your mouth and I don't hear it. It's kind of, maybe it's a little bit delayed.
Let me go get some earphones, see if I can make this work out.
Okay, sounds good. Sorry, guys, a little bit of technical difficulties.
There's like two microphones in here or something. All right, how was that? Any better?
Yeah, I can hear you. Your mouth is not moving, so it might just be a little bit delayed.
So that's what it sounds like. There's some sort of delay going on. So I'll just keep going, and you guys have to just kind of follow the voice.
Yeah, just keep going. I just won't look at your lips. I'll just continue to hear what
everybody just have to turn their back to the computer, and it might work out better for you. So as far as the loan is concerned, the assets are concerned, we're talking about, you need to be able to spend enough money for down payment, then you need to be able to show enough a capital. We're going to require 6 months reserve.
I'm sorry, Aaron. I think people are still hearing a feedback twice.
Interesting.
Yeah, sorry about that.
Not a problem. Let me see what I can figure out here.
It might be my screen. Okay.
So I'm wondering if yours is picking me up and then punching it right back through the microphone.
Can I mute my mic? Can I mute? Can we go on Zoom? Okay, no, just kidding.
Yeah, mute your mic and let's try it. Let's see if that works.
Mute my mic. Okay. Hello?
You're still talking.
Mute.
There you go. Now you're muted. And I'm not hearing it twice. So that's what it is. It's feeding back through your microphone. So we'll get into, and then all you got to do is after the question is done, just jump on and then go on and off mute. So we need to show a person having enough money for down payment. So typically, let's say it's $100,000 transaction. You put 20% down, $20,000, right? And then you have a cost structure associated with, I tell everybody, budget between $5,000 and $5,500 between lender fees, title fees, appraisal, inspection, taxes, insurance, all those things. So that's $25,500, right? Well, now you also have to have 6 months reserves on that specific property. Let's say the property itself was, let's just say $1,000 a month. Well, now we have to have 6 months worth of reserves on that payment. So that property, so it's $6,000. So now you're at $31,500. We need to be able to show. So then that's just to buy the first one. Well, as you pick up properties, you're going to need a little more capital evidenced for the additional properties you have. So you buy the first one, it's sitting in your portfolio, it's got $100,000 balance. You get ready to buy the second one. Let's say it's $100,000. Now you're back at that $30,100 to be able to evidence enough money to buy that one. But you also have to have 2% of the outstanding balance of the one you just purchased that's in your portfolio. So now that is another $2,000. So add that to it, and then ongoing. So 2,000 for every extra one you have in your portfolio, or 2%, up to 4 finance properties. Once you reach 4 finance properties, it bumps up to 4% of the outstanding balance for anything in your portfolio for properties 1 through 6. Then when you get to property number 7 through 10, now you have to bump it up towards 4% of the outstanding balance for all the properties. Plus, of course, the 6 months principal, interest, taxes, and insurance payment on the subject property you're buying. So that's what one needs to be aware of. Now, when it comes to where we can show the capital at, any personal capital, 401ks, IRAs, mutual funds, checking, savings, any of those types of accounts, life insurance policies. It's a really, really kind of a big deal right now. I use the whole life policy for that. And to me, it's one of the best instruments out there next to buying investment real estate. And one thing that some people have, 403Bs, unfortunately, we can't use that. If it's the type of instrument where you have to either retire or leave your job, it doesn't count as liquid usable funds. You can't liquidate those funds unless something heavy happens to you that would actually impede your ability to get the loan anyway. So that's where that is. Now, as far as the type of loan that we want to get, I focus strictly on the Fannie Freddie conventional type financing. There's lots of other types out there. There's your conventional, your commercial stuff, your different types of loans for LLCs and all that by these different kinds of banks. Well, interesting thing with the market today, they're gone. They don't even offer those kinds of loans right now. It's actually very hard pressed to get a loan beyond $510,400 for even the primary residence because banks are pulling back. But the real estate investor is still being funded in that conventional lending space because it's always been a higher down payment. It's always been a higher credit score requirement. You guys have been held to higher standards. So everybody's being held to the standard the real estate investor's been held to because that's been performing better than the other kind of loan out there for the history of loans. So right now, we're not seeing any real big difference in our side of it. But what we are seeing is that everybody else is having to come up to the standard that I've been working in for over a decade.
Got it. Okay, got it. Thank you. Very, very good. Going off of that is a lot of our conversations in the last couple of weeks too has been around the Fed rates cutting their interest rate down to 0%. And a lot of our optometrist friends are wondering if they should wait until rates go even further down, or should they refinance now? Should I buy a property now? What are your thoughts in regards to the trends of rates in the next couple of months?
I personally see that rates have a higher probability of going up than going down. So the Fed did drop the rate to 0, right? But that is the rate between banks overnight. So what you have is when we put our money in with the bank, do they actually just stack that in the vault? Is it all just sitting there in piles? No, they put it to work somewhere. They go put it and they invest it in bonds. They invest it in stocks. They invest it in different things. Well, what ends up happening if some night something happens and they need capital. So when you go into your bank and say, I want cash, or you write a big check, let's say you put a massive down payment on like 3 or 4 houses, or you're going to buy another practice, you've got to take some of your capital and put it to work. When you pull that capital out of it, that bank may not have that money right there in their coffers to be able to release that much. So they've got to go to another bank and say, we need X amount of capital right now to meet this demand. And then we're going to pull it in from our other sources. We're going to liquidate other places to replace it. Meaning they may have a lot of their depositors' money, let's just say on Wall Street at the time, and it's all sitting right there. Well, somebody comes into their bank, a credit union or whatever, and says, hey, I need $100,000 right now. Like, okay, bam, here it is. But they will go to what they call the Fed window or the overnight bank window, or they'll borrow from another bank. And that's what that 0% rate is, to borrow from another bank while they liquidate other sources they have to put it back into their immediate bank to have on hand. So that it has a little bit of an effect on it, but what that does is that's the Fed kind of indicating where the market's going. Where the Fed's raising rates, then we know the economy is doing well. So the Fed's dropping rates, the economy's not doing so awesome. So how that translates to interest rates getting better in the mortgage-backed securities world, which is where our money comes from, is that evidence is when the economy's hurting, then more than likely our interest rates are going to get better because people are pulling money out of the investment pools, like basically stocks. Stocks will do better when the economy is doing better, right? People want to invest in companies that are making more money. When the economy is not doing so well, they're not going to invest in stocks. They're going to put it somewhere else that's safer. So they go to the bond pools. So a bond is something you're putting your money in there that's now being secured for a longer period of time. Everybody hears about the 10-year treasury. That's like the one where people talk about the most. Oh, the treasury got better, so mortgage rates got better. Kind of, because it's another indicator, because it's a bond, and it's the most widely published bond is the 10-year treasury. But it's a 10-year instrument. You put your money in there, and it's supposed to be payable in 10 years. You're going to receive interest basically for 10 years. That doesn't translate to a 30-year mortgage. So there is a whole other location of funds known as the mortgage-backed securities. And if anybody on here has seen The Big Short, it describes how that came about. There's a character on there by the name of Louis Ranieri. He worked for Salomon Brothers. Not really a character, he's a real man that back in the 70s got to thinking about the banking world, where they would take depositors' money and they would write mortgages from the bank themselves, depending upon the amount of money they had available. So what they would do is they would offer to the community. The community bank would offer the community mortgage rates of X because they have X amount of money in the bank to use. They would lend it out. And then at those times, they're lending it 12, 13, 14, 15% back in the 70s. Well, they would lend it out to the public. They would come back and they'd pay their mortgage, right? Well, the depositors who had their money with that bank had checking accounts and savings accounts getting 5 to 8% return, just keeping the money in the checking account. So Lou Ranieri got to look at that and say, let me think about this. If the banks are making this stupid amount of money, 17, 18%, how can we put this on Wall Street? So in the movie, you'll see he's in a conference room with an overhead projector with a bunch of little houses on the overhead projector. And then he will have, he had a pension fund manager in the room with his team. And they were pitching this to him that they could take $20 million, put it into this pool. They would lend it out through the banks to people buying homes. And he said this famous word, who the hell doesn't pay their mortgage, right? So look at all the money we'd make at 18%. We'll take a piece of it. You take a piece of it. You pay the pensionee a piece of it, and everybody's making money. Now, all of a sudden, they had all the pensions in the world punching money in there. You had other funds, 401ks, IRAs, other countries putting money in there because they were making huge returns. All of a sudden, the bond world of the banking world became a sexy thing. There's parties all the time and whatever else. Money was flowing. Well, then you got to the point where the people qualifying for loans kind of stopped a little bit, right? People, there's a point in our history where people buy a house and just stay in it for a long period of time. I knew guys who grew up in the same house and actually bought it from the parents and stayed in that home, right? We didn't have the type of world we have today where everybody wants to move every 2-3 years. So because of that, only so many people were qualifying for loans. So they had to get creative. Now, come the mid 90s, they got creative and created the no income loans, the no asset loans, the no income, no asset loans, the stated income loans. All these things came about because they needed more people to borrow money because they were making so much money off it. And they were securitizing these things, selling them to people. What we have today is you have the servicing side of it where they would pay 1% of whatever the balance of all those loans are to buy the servicing rights, just the rights to collect the payments. So there's billions of dollars being made. Well, then you have the crash, right? Of 2008, people started pulling out of those pools because, I think it was actually late 2007. I was in Hawaii at the time when a lot of investors across the globe sold their positions to get out of that because they started seeing the extreme delinquency that was happening. And because of that extreme delinquency, nobody wanted to buy any more mortgages because of all the delinquencies, all the default. Then you get to 2008, we had the entire crash because people were borrowing that should never have borrowed. So where are we at today with that? I know that's a hell of a roundabout way to answer where the rates are, but the interest rates right now are being driven by that same supply and demand of money. The same people buying into the mortgage-backed securities pools. In fact, I'm going to see if I even have some charts up that I can share with you guys, and I do. So if you don't mind, I'm going to do a screen share so I can show you what one of those pools looks like. This is what we call the, I don't know if you can see that. Give me a thumbs up if you can see these charts. There, Julie. Okay, there's the chart right there. So you get to manage this. So here's this chart. This is a mortgage-backed securities chart. This basically shows us the last, I think, 3 months of trading. Every single one of these days, every single one of these bars is a day of trading. So this shows us who is buying into the whoever's buying into the mortgage-backed securities across the globe. So what we're going to see here is this is a normal trading day back before the COVID crisis. People buying into it slowly. And this is a big day right here. A day like this, that was a lot of money flowing into the pool. Well, on this specific date here on March 9th, if you look back, say I was on the wrong screen, sorry guys. So if you're looking back here early on, you're going to see all these days here that were just minimal trading days. They were normal trading days, in fact. Then we get to here, March 9th. That's where the whole market got punched into the gut. And you can see everybody starts selling off their positions, huge sales. Now, if you look at this, this covers the last, I think, 3 years. When I click on this particular chart, look at how much we lost. It was almost a year's worth of trading all in about a week and a half. So when you fast forward back into that 3 months here, this is where the Fed decided they're going to do what they did back in 2009, do the quantitative easing again. So the Fed started dumping billions of dollars into this. From here to here is about $160 billion they poured into the market to get it stabilized. And now that it got stabilized, they were actually going to continue to pour money into it. But an associate of mine who was on my YouTube channel that Julie had watched, his name's Barry Habib, he contacted the Fed right here. He said, actually right in here, said, you might not want to do that. Because if you keep buying into this, people keep refinancing for the lower rate. And when they refinance for that lower rate, what they're doing is they're paying off their loan too early. So we talked about the servicing side of the business. The servicing side of the business will buy these loans from us, or at least from Wall Street, for 1% of the loan amount. And then what they'll do is they'll service it. So every time you close on a loan, about a month later, you get somebody else sending you a letter saying to pay them the new bill. So what ends up happening is they paid for that 1% of it. So if it's $100,000, they paid $1,000 for that loan, the rights to service it. Now, they will only be able to keep about $300 a year of what they're collecting. So it takes them about 4 years to break even. Well, what's happening here, because of the rates were so low and the Fed was pushing them low again to spur the economy after this COVID mess, we were risking people refinancing so fast that they're paying off before the servicing side got to actually make any money. So they're losing tens of billions of dollars. So nobody's going to keep doing that service if they're going to lose money, right? So what they told Wall Street was, no, we're no longer buying it from you. In fact, if we're going to do this, service your loans, which you need us because you can't do this, you're going to pay us. So we're not going to pay you $1,000 for a $100,000 loan. You're going to pay us $500. So because of that, there's now a $1,500, really a point and a half swing or a $1,500 swing. So what they've done is they've kept rates low, but now they may be charging a little bit up front, which they didn't do before, to keep the rate low, to keep people from wanting to refinance right away and causing that problem again, but also added a little bit of cost to it to pay that bridge. And also people may not refinance as often because of it. So as you can see, the Fed has continued to put in as much as back here over $8 billion a day. Now they're putting over here, this is today, this is yesterday, $5 to $6 billion a day. That's still an enormous amount of capital going in there to keep the market stable and keep the rates low. Now, the reason I think the rates are going to go up eventually is because I believe at some point the Fed is going to probably there's no probably, they're going to stop putting money in there at some point. They're going to stop investing that $5 to $6 billion a day into those pools. And when they do that, it's going to push the rates up. It just has to. So I think that we may experience some of that at some point. But I think right now, a person, if they see a deal that makes sense, if you see an investment property that's going to cash flow, regardless of what the rate is today, whatever your percentage numbers need to be to make you happy with it, you need to move on it. Trying to wait for the perfect time is like being a star football player sitting on the sidelines, waiting for the perfect time to jump in the game, to be on the highlight reel. The only people on the highlight reel are the ones on the dang field at that time. So get in the field.
Yep, that makes sense. And to add on to that too, my husband and I were just talking this morning is, should we buy our next investment property? Now the question is now a good time, or should I wait until the market crashes? I mean, when is that really going to happen? What I would advise is, like you mentioned, if you find a property that makes sense, you have the money just in case, you can't evict your tenant because the eviction clause is going on for the next 6 months. Do you have enough money to weather that storm? And after that storm, is it going to cash flow? And is it going to, be a good property to hold for the next 5 or 10 years? And if the answer is yes, and you can weather this short storm, then go ahead and buy it. Because if you keep waiting on the sideline until this market crashes, then in 2 years, I'll probably have another 3 more properties. You'll have 5, and the other person's going to have 0, So waiting and waiting really doesn't get you anywhere. But what you can do now is analyze, have good liquidity, right? So that way you can actually get funded, have a solid W-2, would you say, like solid income, and keep looking for properties that will cash flow. What I've done for the last couple of about a year and a half is, I just want to go over this real quickly, just because you're my go-to BRRRR lender. A lot of people have been asking, what is the BRRRR strategy, and how do you as a lender, how are you able to do the refinance less than a year seasoning? A lot of BRRRR investors, they have to wait that 1 year seasoning in order to pull out their equity or the funds that they placed in. How is that you're able to do such thing by taking advantage of something called delayed financing? So can you go over just briefly what the BRRRR strategy is and how you as a lender are able to do that before that 6-month seasoning period?
Sure. So one of the other things I kind of want to hit real quick and back you up on something, what you were just saying about the crash, right? Well, let's think about what's probably going to get hit first. I think what's going to get hit first is your luxury properties, your coastal markets. The ones that are not your big rental markets are probably going to feel it before anything, because one, the lending guidelines are changing so dramatically for that. The homeowners are actually having a harder time buying houses. So that being the case, they're going to need to become renters. If they're becoming renters, we now have a longer line of people wanting to rent houses. So an individual who owns investment real estate, especially single family rentals, I'm not seeing that there's going to be a massive crash there, because they're ready to buy. They're constantly buying. They're seeing deals and they're taking it. So I don't know that we're going to see that crash for that particular side of it. So your turnkey investments, your BRRRR investments, I would not believe that you're going to sit back and watch that happen. The other thing is, think about the people living in apartments right now, sheltering in place. They've got, say, 2 kids living in a 700 square foot apartment with 2 bedrooms. Do you think they're having a hard time with life, with those 2 kids at the kitchen table trying to do schoolwork and them doing their work from home? They don't have a yard to send them out to. They can't send them out to the common area. They probably can't wait to rent a single family investment. And in fact, everybody I'm hearing from right now that manages investments across the country are telling me that their collection of rent is actually a higher percentage of collection today than they've had before. They have more and they have more people putting in applications to be tenants than they had before, and then higher quality. So when you think about that, I don't believe we're going to run into a problem there. I really think that people need to get real about whether or not you're going to invest. If you're going to, you better get after it, because there's a lot of people out there outrunning you right now. If you're going to lay down and lick your wounds in this environment and let the world pass you by, you're going to get back up and try and follow them. They're going to be well ahead of you. So Julie's 100% right there. Now, when you get into, I'm trying to remember the other question. Oh, the BRRRR question. So how we do that? There is a program out there called delayed financing that Fannie and Freddie have had out there for actually since the 2008, probably 9 or 10 when they put that out. That means what it says, what the actual guidelines say, is we can give you, when you pay cash for a property, up to 75% of the value of that property, not to exceed your initial investment. So many people take the initial investment as the purchase price, but in reality, initial investment is whatever you came to the closing table with. So the other rule that we have to live by is cash out refinance is a minimum of 6 months ownership on a property. You have to season the ownership for 6 months before you can take cash out of it. But in the delayed financing world, we can go up to 75% of the value, not to exceed your initial investment. So how we do that is when you go to the closing table, let's say you're going to buy a $50,000 property. And let's say if you put $20,000 of work into the property, you'll be able to get the property appraised for, say, $100,000. So 75% of that 100,000 is 75,000, right? But you put 70 in it. Well, if you just did it to where you bought it for 50,000, went to the closing table, paid 50,000 to the title company, plus your closing costs, they paid the seller, you took ownership, you hired a contractor, paid that contractor 20,000, and now it's worth $100,000. I can't get you more than $50,000 until you hit the 6-month seasoning period, because your initial investment at closing was 50,000. But if you go to the closing table with 70,000 plus closing costs with the title company, which is probably about 800, 900 bucks, now, and then the title company pays the seller their 50,000. They keep the other 20 in what they call a repair escrow, and it says it right there on the settlement statement. Repair escrow. Now I show the bottom line of you paying 70,000 at closing. Your initial investment was $70,000. So when we go to do that appraisal, a few weeks later, it says it's worth 100,000. 75% of that 100 is $75,000. Your initial investment was $70,000 according to that document. I can do a loan for $75,000 because you're going to have, like we talked about before, close to about $5,000 between lender, title, appraisal, inspection, taxes, insurance. So now you get your 70,000 back. You're in the deal for nothing. And we've been doing that I've been doing that for years now. We've even double checked, contacted Fannie Mae and Freddie very recently, had them on the phone and looked at our process, and they said, we're good. Now, Freddie doesn't do that, Fannie does. So we're in good shape there. We've confirmed we can keep doing it.
That's awesome. I just wanted to add in some things, some real life examples. Last year in 2019, I purchased from July to December. I bought 3 properties with 3 properties cash, and you actually did all of my refi. And one of them, you literally explained it exactly how it is. I bought it for $30,000. Well, a little bit, $30,000. I put $20,000 into rehabbing it. So my all-in was $50,000, and it appraised for $100,000. And what I did was, prior to buying the property, meaning prior to sending money to escrow my $50,000 in cash, I texted Aaron like, hey, Aaron, I have a property under contract. I just want to make sure that I'm doing all this correctly. So Aaron would look at my settlement statement. The settlement statement will show that the $30,000 is my purchase price. And then I put $20,000 into a rehab fund in escrow, and escrow would hold that off to the side. And what I would do is I would tell escrow to draw it in, disperse it in 3 draws to my contractor. So when I closed on that, prior to closing on that property, Aaron said, looks good, Julie, you're all clear. Let me know when the property's rehabbed and we'll send out an appraisal. So I wanted to make sure everyone understands that is you have a really good lender on your team that understands delayed financing. I've had so many investor colleagues, optometrists that are very interested in delayed financing and doing the BRRRR strategy. And they've reached out to so many lenders, big lenders, Chase, Wells Fargo, maybe their credit union. And they're all being, saying they're all telling them to wait a year. They don't know what delayed financing is. It's bogus. And I've sent several of them to you. And, I've received so many feedback like, yeah, I was able to pull my money out before 6 months. I was able to put 50,000 in, including rehab. And 3 months later, I got 50,000 back out. And that was what happened to me in 2019. I bought 3 properties and they all appraised so much. After paying all my closing costs, I think I've only spent less than $13,000 of my own hard cash buying 3 properties. And those properties have, are, appraised way much more than how much I put in, and they're cash flowing. So, the key thing is having a lender like Aaron who understands what delay financing is. Set up your game plan prior to you buying that property. And then right when you purchase that property and you rehab it, make sure you send out an appraisal, appraise that property. And then if you do it all right, then you will essentially get all of your invested capital back out, and your equity that you've built through rehab now becomes your 25% down payment through, through a traditional 30-year fixed mortgage through a cash out refi.
So, and then the other thing that you just brought up was what you just brought up was something it's imperative. Before you go in and pay cash for that property, be sure I see that settlement statement first. That's what Julie did. Make sure I look at it. Do not close on anything until I give you the thumbs up to do it. I've talked with a lot of people. I've shared that process with several times, and it's amazing how it is easy to forget one small thing. You forget that one small thing, your money's locked up for 6 months. Give me the time to take a look at it. It'll take only a couple hours for me to be able to get it, section that time out, and take a look at that and give you the thumbs up on that one, because it'll save you that 6 months. The other thing is, when the property is done being rehabbed, be sure that you let your contractor know that you want everything 100% cleaned up. You want all the construction debris gone. You want the tools cleaned up. You want the lawn mowed. You want them to take the weed eater around the darn shed, because I've seen some come back with looks like a jungle around the shed, and they think that that's going to help, or it's not going to hurt the situation. It does. When we let an appraiser in there, they're going to appraise what they see. I know they're supposed to appraise it for what it is in the market as far as the market's concerned, but they're humans. And we're expecting them to use their imagination. I'll just tell you, their imagination suck. So let's not give them the situation where they have to look past all the mess. And definitely don't let the appraiser go in there while you're trying to move a tenant in. We've all seen how a tenant moves in. They got this big, massive crate full of crap. They push it in the middle of the room. They pull a pin, and it blows all over the place. Don't put your appraiser in a position to have to try and sort through that. Give them the best possible property to look at.
Yep, I agree. And then what I do is I always try to get the appraisal's contact information, and they'll always ask me, what have you done to the property? So I'll send them a scope of work, and I won't always kind of give them my idea of what I think it's going to be worth, even though I don't really know anything. I would say I would just make it a little bit more than what it is worth, and I always get it just as how I like it. I'm like, I think that worked. And then I always want to make sure I let them know how much I think it's going to get rented for, or the market rent. If it's going to be $950, I'll say $1,000. It doesn't really hurt to give them a little higher. You always want to shoot a little higher than lower anyways, because at the end of the day, they can just ignore you. But I think in human nature, people like to be in agreement with other people. I don't know, if I think it's going to be $1,000 and this lady is coming from another town that really doesn't know my market as well, she might take my opinion into consideration, or at least some market research that I've sent her. And you're right, I don't do their appraisal after the tenant is moved in. I just make sure everything is nice and clean, that it's completely vacant. And then once everything is done and said and done, then I'll move my tenant in. I have another question in regards to delayed financing. Do you accept any other form of proof showing money in the bank besides cash in your checking account to show, because I know that you need to have like 2 months of bank statement to at least qualify for financing? Can it be a borrowed fund from your friend? Can it be from your cousin, your dad, your uncle, or it has to be from a source in your bank for the last 2 months?
So when you're talking about the cash purchase itself can really come from any source. If it's coming from mom and dad or whatever, you're borrowing the funds, make sure you have a note in place. You got to sign an instrument that's showing, hey, I borrowed X amount, I owe X amount back. If you do that, then the money goes back to them. You can take it from your credit line. You can take it from really any source, as long as we know where it is and it goes back to that. But there also has to be an agreement of payback. It can't be a gift. You can't just say, oh, they gave it to me. Well, then there's really no way to source it. But if we source it through that and send it back to them, then it's possible. And I have done many of those where people have just borrowed the money from mom and dad or their brother, or their cousin. Go through the steps of signing an actual instrument of payback.
Okay, good. That makes sense. What are your thoughts on right now investing in I think I have a question here, in Airbnb, short-term rentals, not investing in them, but waiting for those homes to go down and then utilizing that opportunity to buy rental properties?
So I think that could probably work out really, really well because of what has happened with those particular properties in those markets. So the reason I think that could work out is, and I think your microphone's kicking us back through again. The reason I think that will work out pretty awesome is because, one, they're not renting them out right now, with the situation. And there's a lot of people that may be just up and selling them. But you also want to take a look at the market and see what the rental market is there, the long-term rental market. Don't just go buying it because the deal's good. You could have a great deal on a house that you can't do anything with. What if it's one of those places where nobody wants to rent it long-term? Well, I'm thinking that we're going to get vacation rentals back sometime, but is it something I think that's going to happen immediately? I don't know. This is a human behavior question. We have successfully changed human nature. I mean, I would say human nature, but human behavior. We've changed people's habits. They say it takes, and I read some sort of study that was done over at a college in England, where they said it takes anywhere from 19 to 200 and some odd days to create a new habit. And so maybe there's some people that have no ability to hang on onto any sort of process that they started. But they also said, interestingly enough, it takes about 66 days for it to become automatic. Like, so if you like have a trigger of some sort. Well, look at where we're at now. Look what people are doing. The travel is way down. Going to work is completely different for people. What they do with their time is different than what they did before. They've gotten into a new groove. They've gotten into a new habit. Because of that new habit, it could affect a lot of things. So I think that we may see a huge effect on the tourism industry, the travel industry, the Airbnb stuff. This may be some of those communities that weren't really liking it to begin with, but allowing it. They may come in and just completely change the way that their laws are written, because now it's out. They don't have it in their community anymore. The lobbying that's going to come from the hotel industry and the other hospitality parts of that industry. I don't know if their lobbying is going to get even more intense because they've been so heavily hit by this. That may make it harder to do Airbnbs. It's hard to say what the outcome is going to be, but just think of all the external dynamics around it before you start making a decision like that. A lot of these turnkey markets or these BRRRR markets make sense because they are heavily weighted towards long-term rentals anyway, because of the nature of the industries in those areas. So those are kind of like your tried and true bread and butter kind of deals. And I'm looking at a few of your other questions you had up here. I know that you had asked if a person had a huge chunk of student loans left, should they pay those down to qualify for mortgages? If it's really a big dent in your world as far as those student loans are concerned, I think that we just need to look at your debt to income ratio. There's no blanket statement that I could give there. We need to look at each individual. What is your income versus what are your expenses every month? And if you're buying investment properties, we get to count the rents on those properties to offset the expense. So if you're buying it for $100,000, and let's say the payment on it is $650 a month, and it's going to rent for $1,000 a month, I can use 75% of that rental amount, which is $750, and I back out the $650 out of that $750, and I give you the $100 in income, but I don't hit you with the debt. Now that's if you have a history of owning rentals. If you don't have a history of owning rentals, but you do own your home, or you pay a monthly payment for a rent or whatever, then I can at least use the rents to offset that expense, so that way we're not hitting you with a debt. If you don't have any housing expense whatsoever, you don't live in your own home, you live with family or your parents or whatever, then we have to qualify you with that. And you may be in a situation where you have to pay down some debt. So it's all situational, each person. I know with student loans, they're very, very, very low interest, and they're designed in a way to be really kind of an easy payment. So if you don't have to, I would say don't. But each person needs to look at it for themselves. Another thing you have to do with refinancing your property during a market downturn, like if the housing value decreases, it depends upon what your situation is. I'm never a big advocate of refinancing, especially rental homes, just for rate. In my opinion, rates don't matter. The deal either works with the rate or it doesn't work with the rate. If you're trying to pull cash out to be able to expand your business, then it makes sense. Doing a refinance for pulling cash to expand your business always makes sense in my world, because you're using somebody else's capital to expand a business, and it really is for free because it's not your money. You may have borrowed it, but your tenant's paying it off. And if your tenant's going to pay off that lien for you, and you took that to buy another property and get another tenant, you're not the one who's paying for that. The market's paying for it. Whoever put the money up on Wall Street's paying for it. Your tenant's paying them back slowly. So in reality, doing it just for rate, like I said, is a waste of capital, because, and we'll get this on a future conversation, talking about how inflation pays it off faster for you. I've got all the technical data to be able to share that. But let's talk about, the just the refinance in general and why I believe that the interest rate really doesn't matter that much. I had a client of mine purchasing 2 properties in Memphis, Tennessee. Same floor plan, same price, same potential rents, same street. They were both new builds. The only differences, there are only 2 differences. One had the garage on one side of the front door, and the other had the garage on the other side of the front door. That was really a flip-flop plan. The other is the first property was just about done being built. The second property had yet to break ground, so it was just a bare lot. He closed on the first property December of 2017. And he got about a 4.75% rate, very, very happy with his payment and his cash flow. Well, then Jerome Powell, the current Fed chairman, started with the Fed doing the quantitative tightening, right? So we talked about quantitative easing before, where they dumped those trillions of dollars in to bring the rates down. That's quantitative easing. Quantitative tightening is when they stop doing that, which is what they're going to do again soon. How soon, we don't know. But he took his foot off the gas in the late part of 2017. Rates started to creep up. Well, then you get to May of 2018, the rates creeped up to 5.75%. Well, that was when property 2 was done being built and he was ready to close. When I quoted him on what that new rate was, he said he probably wouldn't close. He's thinking of canceling that deal. I'm like, well, why would you cancel? He said, I'm losing $600 a year on that second deal. He said, explain to me the loss of $600 a year. So, well, the payment difference is $49.97. You round up and factor that in for the whole year. That's $600 for the full year. So, well, fair enough. So, but let me have you do something before you make that decision. He goes, well, what is that? I said, well, initially we said you're the CEO of your real estate investment business, and this is an investment business. This is not just some sort of just single transaction. This is not a commodity or anything of that effect. This is an actual operating business, each property you buy. Well, as a trusted advisor at your board table, I would say call your CPA. He just finished your taxes. It's now May. Ask him, what is the difference in the taxes you will pay on the higher income property, that higher $50 a month higher, versus the lower income property, because we pay taxes on income, right? Then ask him, what is the difference in the tax deduction you get on the higher interest rate, 1% higher rate annually, versus the lower interest, and then come back to me and let's see where we go. Well, about 3 days later, he calls me up and says, let's go ahead and close. I'm like, well, why are we moving forward? He said, when my CPA went back and looked and ran the numbers for me, he goes, it really was no longer $49.97 per month. Once you factor all those things in with my current tax rate, wherever bracket he was in, and the structure that he had put in place, it was no longer $49.97. It was $3.55. So he wanted to move forward. So the one thing that I want to help everybody to understand is that when it comes to real estate investment, you are part of what I mean by what is the most tax-favored asset class on the planet. Nobody gets to take advantage of expenses and taxes the way that real estate investors do. Not only just the interest that you're paying, but you get to take advantage of depreciating the asset, all these things. So remember, there's so many other facets to this situation that you need to consider beyond just what's my cash flow or what's my interest rate. That's a very consumer mindset. This is not a consumer process. So getting into some of the other questions we had popping up here. And how much time did you want to go, Julie? I wanted to ask that question too. So while Julie's jumping back on here to see what kind of time we've got left, there's a question here about investors who reach the limit of mortgages that conventional that you can do. So conventional is limited to 10 financed properties. That's your primary residence. If it's financed, that counts as one. Then any other property you have financed. And it doesn't matter if it's conventionally financed. It can be any type of financing, private financing. It could be commercial financing. If it's financing that pops up on a lien on that property, it counts as a financed property if it's in your name. Now, if you get commercial financing in the name of a single member LLC or a corporation, whatever, it doesn't count because that's a separate entity. But if it's in your name, it does count. So once we get past that, right now, we don't have the options we used to have. We used to be able to go to a whole bunch of different groups on that had hedge funds that they would tap into, and they'd be able to lend out 20% down or 80% loan to value deals, 30-year fixes on multiple properties. Actually, there was not even a limit. But when the market freaked out a little bit, those hedge funds pulled back. So at the moment, we don't have any of those options available. But we can see what's going to happen once the things normalize. We hope they do normalize. There's also been questions about portfolio loans, meaning can I finance multiple properties with one loan? That has existed. It doesn't exist right now because of the same situation, but it has existed. But just know it's got to be a big loan amount. Minimum of $500,000 is what I've heard with many of the people that were doing that in the past. With that $500,000, they're charging a large chunk of money up front. They're charging somewhere in the range of about, if I remember correctly, $14,000 just for the legal fees to do the cross-collateralization paperwork. To be able to put one loan to cover multiple properties takes a lot of legal paperwork. And to make that happen, you got to pay the attorneys. And the attorneys they're not cheap. These guys, to be able to make that kind of deal work, it's going to cost you a few bucks. So most people are thinking if they're going to do this kind of loan or any kind of loan on multiple properties, that they're going to save money by doing one loan on multiple pieces of property. Doesn't work that way. It's increasingly expensive. So you better already have a pretty good portfolio to work off of before that. And we are rolling up to the top of the hour, guys. And I do know I have some stuff coming up that I've got to be on right after. It's coming up on 2:55 p.m. Pacific. I've got to be on some things at 3 p.m. So ultimately, I just appreciate you guys allowing me on here. Check out my website, aaronbchapman.com, AARON, B as in boy, boy's not my middle name, CHAP as in Paul, MAN.com. That goes to my business website. You'll see this redneck sitting on a porch. That happens to be my office in Missouri that I'm sitting at. Cabin built in the 1800s. I purchased and rehabbed and leased back to my company. But that site, you can see my licenses, what states I'm licensed in, my company's licensed. You can look us up on the NMLS website, which is Nationwide Mortgage Licensing System or Service. I can't remember which one it is. My license number 267844. You look me up there. Make sure you know enough about me and know that you're dealing with somebody who's real, and that this is just somebody that Julie had tossed on here for some entertainment purposes. I want to be able to fulfill that same obligation for all of you, to be able to be that trusted advisor at your board table for your business, to be sure that when you're trying to experience something new, right? You're buying investment property for the first time. You're going to face things you've never experienced before. You're going to face questions you've never had to answer before. There's an old saying out there that says good judgment comes from experience and experience comes from bad judgment. That works great on the playground when you're learning how to fight, but it doesn't work real well when you're trying to do investment, because real estate can cripple if you're not doing it the right way. So the reason I say that is, as Julie had pointed out, I do thousands of transactions. Last month was 34 transactions closed for real estate investors. Last year as a whole, 723. Year before that was 707. The year before that was 676. The reason I say that is I've seen a lot of people's judgment-making skills at work. I've seen where they've failed and where they've succeeded. My goal is to give you the best practical data so you can make decisions as the owner of your business. So thank you for tuning in and giving us your time. And if Julie, you got something to jump in here and share with us, we'd love to finish this thing out the right way.
Hey, Aaron.
There you are.
Yeah, thank you for your time. I know you're so busy, so I really appreciate you jumping on this call with me. I think you answered all of the big chunk of the questions in regards to mortgage lending and all those questions that I can't answer. There's some other questions that some of the doctors have, so I'll stay on a little longer just to answer them. But I just want to say thank you to you just for being such a great partner and, in my real estate investing journey. And, I just want to say your time is so valuable, and I hope we can continue to build our business together as well too. And if there's anything else that any of these our doctors have any questions that I can't answer, I'll shoot it over to you as well.
Well, thank you. And I appreciate you again letting me on here, and I will I'll make myself available for us to keep doing this as often as we need to.
All right, Aaron, I'm going to let you go and do your go back to your business, and I'll just continue just answering some other questions from the doctor, and then we'll wrap it up.
Thank you.
Thank you.
All right, guys. Hope you can hear me. Thank you so much for staying this far along. We have about maybe 2 minutes left. I just wanted to answer this quick question that someone posted. What do you mean by delayed financing? If you can get your cash back within 6 months, you still have to pay a mortgage and pay it off. What am I missing? So if you purchase a property, let's say it's $100,000, and you don't do delay financing, you just purchase it outright, you'll have to put down either 20 to 25%, not including closing costs. So your out-of-pocket cost to buy that property, that investment property, is going to be $25,000 to $30,000. In regards to the delayed financing through the BRRRR strategy, what you're doing is you're allowing your equity to become your down payment, and that equity, because it's your down payment, you're able to pull out 75% of the appraised value of the property. So let's say that value is $100,000, but you've only put in $70,000 or $75,000. You're able to pull out the entire amount of the appraised of that value out, 75% of it. So $75,000 out from that property. So if you put in $75,000 and it appraised for $100,000, once it finishes rehab, you have now $75,000 back in your bank. So the question is, well, why do I want to do that? Why don't I just do the route, the first option? Well, the first option, you have $30,000, now stuck in that deal. While the second option, doing the BRRRR strategy, you will let your equity become your down payment, and none of that money is in that deal. It's all back in your bank. And yes, that $75,000 now becomes a loan that's amortized over 30 years. But when you think about it, you'd rather have your property and the equity in that property become your loan versus your own cash and hard money stuck in that deal, which you probably won't, make back until probably another 6 months or a year. So you're essentially letting debt work for you and not delaying your time and resources and waiting to acquire another property. So I just wanted to kind of clarify that. It's just a very popular term that people on Bigger Pockets have been using. A lot of real estate investors are using. It's just the BRRRR strategy, which is the buy, rehab, rent, refinance, and then repeat. And the caveat that a lot of investors are facing is they have to wait a year. But with delayed financing, there's really no wait time. You just have to wait until your rehab is complete. That way your value of your property increases to what the expected value of the house is going to be after completion. And then after that, then you can pull all your money back out. I think that is all of the questions that we have for now. If there's any other questions, just feel free to shoot me a private message on OD on Finance, our Instagram page. You can shoot me some questions there, or you can just follow me. My Instagram is house hustle. And you can ask me questions there and follow me along. Currently, I'm working on a duplex that I purchased about almost 2 months ago. And once it's completed, my next step, of course, is to get it appraised and refinance and pull all my money back out. And then, of course, get it rented. So follow along with my journey. I'm almost at the refinance stage. And then I'll let you guys follow along and see how things go. But between now and then, feel free to shoot us any questions, myself, Dat, and Aaron, and then we'll be sure to share it on the Facebook group. All right. Thanks, guys, for joining in.